hearing a very specific formula for success. Get a good job, work incredibly hard, earn a high salary, and you will eventually become wealthy. But for millions of high earners, that equation never quite adds up. The problem usually starts with how we handle our paychecks. Most people operate with a leftover mindset. The money comes in, the bills get paid, the groceries are bought, and whatever happens to be left at the end of the month goes into savings. Relying on those leftovers is a risky strategy. When cash just sits idle in a standard bank account, inflation slowly and quietly eats away at its purchasing power. What felt like a comfortable buffer last year buys significantly less today. And as incomes rise, that leftover pool rarely grows. Instead, a bigger salary often triggers lifestyle creep. People buy expensive items, like luxury cars, mistaking them for signs of wealth, when in reality, they are liabilities that drain monthly cash flow through loans, insurance, and maintenance. Without a deliberate system to capture that money before it disappears, even the highest earners find themselves stuck on a treadmill, making plenty of money but perpetually fighting for financial survival. So how do we step off that treadmill? It requires a complete shift in focus, away from laboring for a salary and toward acquiring things that generate money on their own. This specific framework for viewing wealth was heavily popularized by financial author Robert Kiyosaki. He defines an asset in the simplest possible terms. It is something that puts money into your pocket, whether you are actively working or not. It could be a rental property, a dividend-paying stock, or a piece of intellectual property. Financial freedom arrives when the passive income generated from these assets exceeds your monthly expenses. Under this ownership paradigm, wealth is a direct measurement of ownership and cash flow, rather than a tally of labor or social status. Once you own an asset, you can apply a mathematical accelerator. It's the principle of compounding, a concept so powerful that Albert Einstein famously referred to it as the eighth wonder of the world. Compounding works by taking the returns generated by an investment and immediately reinvesting them back into the original principal. You aren't just earning money on your initial cash, you are earning returns on your returns. This chart shows the growth of a 100 Rand investment in the South African equity market, tracking over a massive 62-year timeframe from December 1960 all the way to 2022. If an investor chose to simply have their dividends paid out in cash over those 6 decades, their portfolio grew to just over 104,019 Rand. That's the lower, relatively flat orange line tracking across the bottom, but look at the blue line. If that exact same investor chose to reinvest their dividends, the compounding effect creates an explosive upward curve, driving the final value to over 1.4 million Rand. By the end of 2022, a staggering 93% of the total investment value was generated purely by those reinvested dividends, with only 7% tied to the initial capital. The math is entirely objective. Time and consistent reinvestment are the true engines of extreme wealth accumulation, far outweighing how much cash you start with. This brings us to a glaring paradox. If the math of compounding is so flawless and accessible to anyone, why do the vast majority of investors fail to achieve these results? Financial researchers call this the behavioral gap. It is the measurable discrepancy between the high returns a mutual fund actually generates and the significantly lower returns an individual investor actually takes home. The culprit is our own biology, specifically a psychological trait known as loss aversion. Studies show that the emotional pain we feel from losing money is roughly twice as intense as the pleasure we get from gaining it. When inflation spikes or markets face a sudden correction, that intense emotional pain overrides logic. It triggers an irrational, herd-like panic, causing people to scatter and abandon their financial strategies all at once. This biological fear response convinces people to hit pause on their systematic investments, withdrawing their money at the exact moment the market is bottoming out. We are hardwired for survival, but in modern finance, that instinct actively sabotages us. It forces us to sell our assets out of pure fear precisely when they are the cheapest to buy. Winning the financial game means acknowledging these biological flaws and building a structure that systematically separates your investment decisions from your emotional state. The most effective defense mechanism against our own impulsivity is a principle called paying yourself first. By automating a systematic investment plan, or SIP, Your money is routed directly into an investment fund before you ever see it. This introduces behavioral friction. It forces you to acquire assets first, leaving only the remainder for your daily expenses and liabilities. Automated fixed payments utilize a principle called rupee cost averaging. Because the payment amount is constant, the plan inherently purchases fewer shares when the market is expensive and more shares when prices drop. This structural barrier creates behavioral alpha. By the time a market dip triggers a headline, the automated purchase has often already happened, ensuring the investor remains committed during the very moments they would otherwise hesitate. Building extreme wealth requires ignoring the impulse to react. It is the result of automating ownership and allowing decades of compounding to function without human interference.